Our next guest has been described as one of Wall Street's biggest bulls. He expects the S&P 500 to end the year at a level of 5,200. That's more than 10% rise from yesterday's close. And he is among a handful of Wall Street veterans that also believes the S&P will surge to new highs this year. That would, by definition, we're just a couple percent away, right? Here with us now is John Stoltzfus, Chief Investment Strategist at Oppenheimer Asset Management. John, good to see you.
Good to be here. Thanks.
So it's interesting, on one level, you kind of think we can have a pretty good year. On the other hand, when the biggest bull on Wall Street saying we got maybe 10% upside, it suggests overall sentiment maybe is somewhat subdued. How did we come into the year in terms of maybe everybody expecting a soft landing, and which direction of the surprise is going to go?
Well, Mike, I think actually, in December when we put the target in, it indicated 13% upside. Yep. But that would still be about half of what the market did last year. We can't help but think a good idea to be conservative in here moving into this year, in the sense that we do expect things are getting better. We're moving towards a normalization, stabilization in interest rates. And with that, the thought is still we've got plenty of volatility out there in terms of uncertainty in geopolitical risk that could actually affect food and energy supply chains in a part of the world that's important. And so a lot of thought there.
We know that a slowdown should happen of some character, right? We had like a 5% GDP quarter, third quarter. It's a question of how much, right? So yesterday we got the job openings and quit rate data, a little bit soft. You see labor market slackening a little bit. Manufacturing still not really bouncing back. And I guess the question is, are we going to be able to stay on that path of slower but not stalling?
We can't help but think that slower but not stalling. We think the Fed has been amazingly sensitive to the effects of it practicing its mandate on the economy. It's part of what we call the Ben Bernanke legacy, and we think Powell is practicing that. When you consider, something like 11 hikes and 4 pauses or something like that in so far, and no recession. Mm-hmm. The resilience that's seen in business and the consumer as well as in labor. All of this looks remarkably good, and we think the Fed is, we've said now for over a year, we might actually skirt a recession, and now we're even beginning to think perhaps we do get a soft landing, which would be remarkable.
John, most reports I see believe earnings have to come down, estimates have to come down. How do we get 10% higher? Is it through higher valuations, higher PE multiples, or is it a contrarian when it comes to the direction of earnings?
I think it's a combination of both, Steve. And I think if we just look at third quarter earnings, just think of third quarter that we just got through. When you looked at earnings that originally was expected, consensus was looking, I think, for a 3% decline going into earnings season. Then it kept cutting it, maybe 0.7% decline, and actually had about a 4% gain in earnings. You had only 2 sectors negative. They were double-digit earnings negativity. It was energy and materials. You had, I think it was 5 sectors had double-digit earnings growth, including consumer discretionary, technology, and a number of others.
So do you think the street's too bearish on earnings in general? And what's your forecast? I don't know how it matters to the overall thesis, but we're just about on the cusp of earnings season. What's your expectation?
I think we're looking. I know what we're looking for is we're expecting some positive surprises as we saw last year in both second quarter and third quarter earnings. We think analysts have been remarkably conservative in anticipating how companies are going to perform, and companies have used technology to weather and navigate what would normally be a pretty tough environment when the Fed is in a Fed funds hike cycle.
John, your target implies, the way you get to the math, is something like a 21.7 times multiple on this year's earnings. Why do you think the market should be able to sustain that? And I guess what are going to be the components of it? Because you can slice the market up and say parts of it are expensive, parts are cheap.
Yeah, I think, Mike, when we look at this, we have to say that, you look at the generations, Leon Cooperman's generation, stocks are cheap at 12. Yep. Boomers think it's between 14 and 16 cheap. X generation, a little bit higher. And when it comes to the millennials and forward, an 18, 19, 20 times multiple looks pretty good. I think what's happening, the news items that say 58% of households now have equities. Some exposure to equities. We think that really shows that people are looking, it's not just fear and greed, but need in terms of planning, whether it's for a kid's education, retirement, when Social Security may not be able to deliver what it once delivered in terms of one's retirement. And where are you going to go? Its fixed income is fairly limited, even at 5% versus inflation and after-tax results. But you look at equities, owning a good business historically, past performance, no guarantee of future results, it's usually been a pretty good idea, and equities offers that with prudent diversification.
I have to say, though, there's a lot of S&P 500 stocks trading at 10 times earnings, no matter what people's long-term retirement needs are. So I just wonder if it's about these huge businesses that are kind of winner-take-most, that got all the attention last year, that have 30 times multiples, like a Microsoft and things like that, whereas it's leaving a lot of other stuff out there that at a different valuation range.
Well, we begin to see a broadening in the rally, most certainly. And, yesterday and the day before, we saw a lot of what used to be, I think it used to be called garbage to gold. Yeah. You saw a lot of jumping of things that had underperformed. But within the other sectors, within value, growth year value, there's good opportunity, we feel, as many companies invest in technology to maintain a good premise for investors to invest in value companies by virtue of being able to maintain a good cash flow and profitability and revenue growth.
Do you think there's going to be some kind of a reckoning? We were talking earlier about what's implied in Fed expectations. And I guess you have to ask, is that plausible that rates get cut a significant amount by the end of the year? And do stocks need that to happen to perform?
We think in the first few days, the first 2 days, there was a thought of, well, maybe that was wrong, looking for 4 to 6 cuts. Yeah. We haven't been part of that camp anyway. We think the Fed is likely to maintain the regime that it currently has, probably just pausing for longer. And with probably in the fourth quarter of this year seeing a cut, 1 or 2 cuts, and then not for emergency purposes, but rather just realizing they're a heck of a lot closer to their 2% target.